welcome. In this on-demand video, OJM Group partner David Mandell discusses two wealth planning options that offer upside potential while also providing downside protection. If you have more questions or want to learn how to incorporate these options into your financial strategy, click the link below to schedule a complimentary one-on-one consultation with one of our experienced team members.
Hello, this is David Mandell, principal of the OJM Group, and today we are talking about two topics that I originally did this video for in the beginning of the COVID pandemic, as markets dropped significantly, and a lot of physicians were asking about investments with downside protection. And physicians are asking some of those same questions with what's going on in the world today. We've got, for a while now, significant inflation, and I thought this was an excellent time to revisit this topic. Two wealth planning options with upside exposure and downside protection, the tools of equity index, universal life, and structured notes. So please enjoy.
Well, as I'm recording this, the first week of June, we are still well in the, I think, early phases of the COVID-19 crisis, according to the medical experts. And from a wealth planning point of view, it really leads to a focus on volatility. Now, as I record this the first week of June, we've had a pretty significant rebound of the market downturn in March. I mean, for some of the indices, we're back up close to where we were, and certainly there are some sectors that are even in the positive today. But we're just in the beginning of June, and who knows, by the time you listen to this, watch this, or come back to it later in the summer or in the fall, where the markets will be. I'm not here to predict that. We think that volatility will be high. There's a lot of assumptions baked in what's going on, what the future will be, and who knows what the future will be from a medical point of view. So then that'll obviously affect the markets. There's always a level of risk and reward throughout a portfolio, and that's always true in good times, in bad times. But in sort of unknown, as we are today, people get a little more focused on the risk part of the equation. And I think that asset classes that have some upside potential, yet downside protection, while they're always of interest, because that always sounds good to people if they can limit their downside and protect and have some upside potential. This is especially true in volatility, and I think it'll be true for this year in 2020 and perhaps the next couple of years. So today I'm going to talk about two asset classes that give you that ability to protect your downside, but also give you upside exposure, which is equity index life, universal life insurance, EIUL, and structured notes. So I'll start with EIUL. Okay, first we have to step back, and there's some other videos that get in a little more depth here, but I'm going to take a slide or two and step back and put it in perspective on permanent life insurance. Okay, a lot of people have heard of life insurance, and they might have term insurance. In term insurance, I have it in a number of contexts in my business personally. And term insurance is an inexpensive way, and we have a whole chapter on this, actually a couple of chapters on life insurance in our new book, Wealth Planning for the Modern Physician. We compare them, and term insurance plays a role. It's a cost. It's not an asset, meaning you pay it every year. If you don't die, then there's another premium the next year, depending on the term. But it's not an asset for you. It only pays out when you pass away, but it has a very important role. I use it myself. Permanent life insurance is different, and I have a number of policies there, both at the business, as part of a non-qualified plan, but also personally. This is an asset, okay? As you can see here on the slide, it's part of a total portfolio. It's an asset class because there's a cash component to it, an equity component to it, okay? So in addition to the death benefit that pays out when you pass away, there's actually a cash value portion that you can have access to. And that cash value equity component grows. And under the tax laws, what makes it so attractive is it can grow tax deferred, meaning so there's no tax on it while it's growing, and can be accessed tax free. So in a lot of ways, you can think of it as an unlimited Roth IRA and a lot of our clients use it that way. Also, in many states, there is a significant level, if not total level, of protection from creditors of that cash value. As an example, I live in Florida. Florida has an unlimited exemption for cash value life insurance. I could build up millions of dollars there. I can access it tax-free. It's also totally protected from my creditors. Okay, so the permanent insurance is also called cash value life insurance, and of course there is still a death benefit that pays out, just like with income taxes, that generally pays out income tax-free. Okay. Now, when you have permanent life insurance or cash value life insurance, there's a number of ways that you can build up that cash value. Okay. There's whole life insurance, and a lot of physicians make the mistake of calling the entire universe of permanent life insurance whole life insurance. Okay, whole life insurance is one subset of permanent or cash value life insurance. Whole life insurance is the one that's been around the longest, so that's often why people call it that, even though it may not be. They may have a permanent policy, but it's not whole life. They call it whole life because, you know, back in the 1970s and before that, that's really all that existed. Whole life, that cash value buildup basically is like a bond return. It is a dividend that each life insurance company for their products issues a dividend based on their specific portfolio. Returns are very similar to highly rated corporate bonds. In 2020, many of the insurance companies have already credited or have announced their dividend rate for this year, and it's typically somewhere in the 5 to 6% range, which today, especially tax-free, doesn't sound too bad. Next up the sort of chain in a little more risk and return is universal life insurance. Again, it's also based on the insurance company's portfolio. It's also similar to corporate rated bonds. The difference is you have more flexibility in universal life than whole life in terms of paying premiums and other elements. There's more flexibility there. So that's the second way that life insurance can grow. Now, EIUL, Equity Index Universal Life, is a subset of universal life insurance, but it does not, the growth is not tied to the insurance company's general account. It's tied to a floor and cap option or hedge strategy tied to popular stock market indices like the S&P 500. And I'll talk about that more in the next slide. If you kept going down sort of the risk return profile of these products, you would then go to variable universal life, again, another universal life option. So there's flexibility in terms of premiums, but it's variable. And so the funds go into these sub-accounts, which are basically mutual funds, okay? And they have few, if any, guarantees from the insurance company. So there you don't have, as I'll talk about in the next slide, a floor and cap strategy with the IUL. You have just a mutual fund, basically uncapped, so it can grow, but no floor, no downside protection. So it doesn't really apply to today at like the equity index does, which is we're talking about investment options that give you downside protection yet upside potential. That's what the equity index universal life does. So what is this cap floor collar strategy? Okay. Again, as I mentioned, they're tied to popular stock market indices with floors on the downside, caps on the upside, and what are called participation rates sort of in between. Okay. So there's a lot of different indices you could use in various products. You can even change within the product and have various indices or move from one to the other. The S&P 500 index is the most popular. Again, I have a couple of policies like this myself. They grow tied to the S&P 500 index. Again, insurance companies and products range on the floor, but most of them are in the 0 to 1% range. So if I have a policy, let's say that is a 1% floor, that means if the S&P does less than 1% or negative, my cash value will still grow over that period. Let's say it's a point to point over a year, at least minimum 1%. Can't have anything less than that, okay? That's the downside protection element. Upside potential is in that index. And I'll actually go to the third sub-bullet and then come back. And so if my policy is tied to the S&P 500, the participation rate is what percentage of the index's gain will be used to calculate the interest rate that's applied to the cash value. It could be 100% or some other percentage lower or higher. So if I have an S&P 500 index policy that has 100% participation rate, and the S&P does 8% in a particular year, then my cash value will be credited 8%. Okay. If the S&P does 4%, then my policy will be credited 4%. If the S&P does negative 4%, well, the floor is going to protect me. Again, if my floor is 1, I'm going to get at least 1. Okay. At the other side of that is the cap. Well, the cap, again, ranges around 8 to 10%. Okay. So I have a 1% floor on the product and a 9%, let's say, cap. Then again, and 100% participation rate, then my cash value is either going to grow at 1%, if anything, if the S&P is less than 1 or negative, between 1 and 9, and it's going to get capped at 9. So last year when the S&P did nearly 30%, and I had that kind of policy in place, my cash value would have grown at 9%. Okay? So there's lots of options here, but ultimately the point of this and the attraction, I think, for me and for other clients is that you get some upside potential, especially with some of those tax benefits, but you're capped on that. But in exchange for that, you've got a floor. Okay, not going to lose cash value because and the index has gone negative. Here's kind of a visual that shows the market index, right? And then in the negative years, you see a flat, even horizontal line. And what that does is if you can take out the negatives and keep them at 1% or 0, you know, some of the products have a 0% floor, and they call 0 is your hero, right? Because every year where you're down in the index, you're not down in the product in terms of the policy value. And then you can capture a lot of the upside, not all of it, right? You're certainly not going to capture the years where it's 30%, but if you, as part of your overall portfolio, again, that's the big picture, volatility while we're talking. If you can have a product that grows to some degree up to 8, 9, 10%, but has floor on the downside, that can be an attractive part of the overall portfolio, especially when your alternative, if you want to get some downside protection, might be, you know, asset classes like cash or treasuries or money markets where you're getting, you know, almost no performance, you know, 1% or something. So again, that plus the tax benefits and the asset protection make it very attractive to many physicians. This gives you some kind of long-term perspective of the S&P with dividends, the S&P without dividends, and an index without dividends, what with the collared strategy. You're clearly not going to perform. This is over 30 years from 1986 to 2016. So you had some high years in there. You had a couple of market contractions like 08, 09, and also the dot-com bust in the early 2000s. And obviously, you know, S&P with dividends, S&P without dividends, a lot more volatility, certainly higher returns at the end, okay? But we don't, you know, recommend this would be the only exposure to S&P and other indexes of our clients. This actually can, you know, work as more as a conduit between the all equities and just bonds or cash, because obviously it does better, much better than that. And you can see over the period, you have one from a visual point of view. If you look at the graphic, you can see it's much more smooth, right? That's the point. Not much volatility, but still getting some upside potential, a smooth ride up. What I think you see in the chart to the left, you know, standard deviation is a measure of risk. You folks know that as physicians looking at plenty of statistical studies in medicine. And what I think you see is the average return, even with the S&P of dividends, is 12.7 versus 6.4. So almost double. So the index without dividends and within the policy, within the floor and cap, 0.10, you're capturing a little more than half of the return of the S&P with dividends, 6.4 to 11.7. But you go down to the standard deviation. The standard deviation is 4.45, yet the standard deviation of the S&P is 16.78. So you're capturing a little more than half of the return with a little bit more than a quarter of the risk of the volatility. Okay, that's a pretty efficient place to be, right? So you can capture half of the return with almost a quarter of the volatility. That is a pretty efficient place to be with that piece of your portfolio. And that's why it may make sense to a lot of clients, why it makes sense for me personally, and why it's one of the asset classes I'm covering here. So equity index benefits and risks, downside protection, upside potential. Well, that's what the topic here today. Cash value grows tax-free, and if managed properly, can be accessed tax-free. Huge. That's 6.4. If it's growing tax-free and come out tax-free, becomes even more exciting. And again, in many states, the cash value is totally protected from lawsuits by state statute. Risks, there are surrender charges in these kinds of policies, all kind of permanent policies in the first 8 to 15 years. Again, depends on the product and the company. And that means limited liquidity. We don't recommend you go into this product if you need all the money out in 5-10 years. This should be a long-term structure. Think of it like the unlimited Roth IRA. You wouldn't put money in a Roth just to pull it out in a couple of years. Same thing here. It doesn't mean you can't take some money out. If I have a couple $100,000 in cash value, which I do in one of my policies, if I want to take 50 grand out, I can take it out tax-free tomorrow. But I can't take it all out and surrender the policy without, if I want to avoid those charges in the first years. Also, when you design a policy, if there's deviation from the scheduled or designed premium schedule, that will negatively impact performance. Okay. So again, as you're working with your advisor and you're mapping out how to pay premiums, you want to try to stick to that. And that's pretty true of any asset. If you're investing in real estate and you stop paying the mortgage or paying less of it, obviously it's not going to perform the same way. And carrier risk is always important. We often recommend mutual insurance companies because the mutual carriers, like the ones I use myself personally, I as a policyholder own the company. It's not owned by outside investors. They don't have to make Wall Street estimates or earnings. We own the policy. So if people are living longer and costs come down in terms of mortality, we as policyholders get the benefit. I like that. But again, carrier risk, always important. We're going to pause for a second. Kathy, I just want to get some water. Hang on one second. I'm sure John can.
This conference will now be recorded.
The second strategy I want to talk about today. The second strategy I want to talk about today, which offers upside potential and downside protection, are structured notes. Okay, where the first strategy or product was a life insurance policy with some caps and floors. This is a note, a structured note offered by banks. Okay, typically the largest banks. They offer these, okay? There are what are called a derivative because their value is derived from another linked asset. Okay, a structured note is a note. So you purchase something, you get an agreement to pay you back. And it depends on the issuer, i.e. the bank, repaying the underlying bond in a premium based on the linked asset, okay? Less the bank's fee, of course, they charge something for that. So most structured notes generally have 4 common elements. Maturity. When does the note mature? When do you get your your payout, right? Most notes are in the 3 to 5 years, but they can be as little as 6 months to many years. Okay? There's a linked asset, meaning in that note, in the derivative nature of it, what is the key asset that that value is linked to? It could be a stock, it could be a bond, it could be an ETF, it could be an index, currency, or commodity. Lots of flexibility here, okay? There's payoff. That's the amount the investor will get at maturity, okay? And then there's a protection element. What's the level of protection the investor gets if the linked asset loses value? Okay, so maturity, linked asset, payoff, and protection. Those 4 elements. There may be a lot of other important factors, but those 4 are typically found in each structured note. Now, there are generally 2 types of structured notes. Okay, they generally fall into one of these 2 categories. Again, there's a lot of flexibility, and so not everything falls neatly in here, but there's growth notes where the investors receive a percentage, again, also called the participation rate. We saw that term in the life insurance structure of the underlying assets price appreciation, okay? And with some protections to it. Again, kind of similar in thought of what was going on in the EIUL. And then there's income notes, which over an income notes life, the investors receive a fixed payment known as a coupon. Income notes do not participate in the upside returns the way a growth note does, but it may generate a higher income stream than a typical debt, a security, or dividend paying stock. So again, it depends on the goal of the client. The client is trying to grow some assets, growth, but have some protection. Then a growth note is typically applicable. If client's trying to get some income out of the assets, but wants some protection, then income notes. And because protection can be offered for both the principal and the coupon payments. So lock in or have some downside protection, not only on the principal, but also on income payments. I think the best way to understand a structured note is example. So let's talk about Physician Phil. Physician Phil invests $100,000 into a structured note offered by Big Bank. The note is tied to the S&P 500 index with a 30% buffered protection level in a term of 3 years. So this is a growth note. Phil wants to invest into the S&P 500 and get some of that get that upside, but also is concerned about downside. So rather than just putting it in the index alone, he'll tie it to a note, or it'll be tied to a note offered by Big Bank. They're gonna have to pay the bank their fee, but then they get some downside protection. Let's see how that works, okay? Kind of 3 scenarios that can happen. If the S&P 500 is positive over that 3-year period, Phil will get that $100,000 back, plus the growth based on the S&P 500, less Big Bank's fee. So there's no cap to it, okay? S&P is up 30%, they'll get 100,000 plus the 30%, less Big Bank's fee. So in this way, Phil enjoys the upside of the note, okay? Now, if the S&P is negative over the 3-year period, but not below the 30% buffered downside protection, i.e. down between 0% and 30%, Phil will get the full $100,000 back, less the bank's fee. In this way, Phil benefits from the downside protection of the note, okay? If the S&P 500 is more than 30% negative over the 3-year period, Phil's payoff will be subject to the downside of the index beyond 30%. For example, the index was down 40% at maturity of the note, Phil will lose 10% on his initial investment, not the full 40, because his note had the 30% buffered protection level. He'll lose only 10% plus the bank's fee, okay? So if it's up, he gets all the up. If it's down and it's within the buffer, he gets his principal back. And if it's down beyond the buffered amount, he gets just that difference. He loses just that difference. The buffered amount's still protected. And for that, he pays the bank a fee. So structured notes, benefits and risks. Well, the benefits is obviously the topic of today. You get, as we saw with Phil, upside potential, full example, in his example, full participation in the S&P 500, but also downside protection. In his example, as long as the S&P wasn't down 30%, he gets all his money back, less the bank's fee, okay? Risks, these are complex. I mean, I'm going through this in a couple of slides. These are complex financial instruments that have a lot of different moving parts and long legal agreements, et cetera. There's a lack of liquidity. Okay, so if you need to act, let's say in Phil's case, he needed to sell this, get out of it, get as much cash back as he could within that 3 years, that there's typically going to be a buyer for that, but they're going to buy at a deep discount because they know you're desperate. These are not meant to be sold before maturity, so that lack of liquidity is a risk. And again, like the life insurance, there's issuer risk. Ultimately, the structured note is only as strong as the issuer. If the issuer defaults, the entire principal could be lost. This is why you want to be looking to the biggest and ideally the best financially capitalized and conservative banks. Thank you for listening.
OJM is a multidisciplinary wealth management firm. For nearly 2 decades, our firm has helped physicians across the U.S. reduce taxes, protect assets, and achieve their financial goals. OJM Group offers viewers a complimentary consultation where we can answer your questions to see if our firm might be a good fit for your situation. Simply click the button below to schedule your free consultation. We hope to speak with you soon. Thanks for watching.